Houses, and today I'm back with another video. In today's video, I'm gonna talk about something that's very important. I'm gonna go over 3 key things you need to look at when you are looking to borrow money as an investor, or when you're looking, in general at a loan. 3 terms you should be familiar with, and kind of what you're looking for when you see those terms to be, to be safe, right? Hey, what's up, y'all? It's Al Rehabs Houses, and today I'm back with another video. In today's video, I'm gonna talk about something pretty important. When you're looking to borrow money for investment properties, I'm gonna talk about 3 terms or things that you need to look into and be familiar with when you're looking at a loan and trying to decide if it's a good fit for you or not, right? These 3 things are in no particular order. They are all important, and they're all things that you should know before you decide whether to commit or not to a particular loan or with a particular lender, right? So number 1 is the rate, right? We all want to know about the rate, right? So the rate is always going to be important. Most hard money lenders, talk in terms of a year for the rate, right? So if they say, let's say 12%, that's only 12% per year, right? Not 12% per month. So throughout this video, let's just use 100,000 as the example. It's just an easy example, right, to use. So let's use 100,000 as the example for the amount of the loan that you want to borrow. So if if a lender says that he has a 12% rate on a $100,000 loan, that means that you'll be paying $1,000 a month, right? $1,000 a month, 12 months, that equals $12,000, right? That's 12%. So normally, in addition to the annual percentage lenders charge, they also charge what they call an origination fee or origination points or just points, right? So when you go to a lender, you'll say, what are your rates? And they'll normally express it in something like this, 12 and 2, right? Or 12 and 3, or what have you. And depending on how much experience you have, those numbers may change, right? Or depending on the lender, those numbers may change. But I'll just use 12 and 3 as an example. So it's 12% per year, which I explained, right? And then the 3 is the amount of points. So a point is 1% of a loan. So in this case, again, we're using $100,000. So each point is $1,000. If you have 3 points, that means it's 3% of the 100,000. So it's $3,000, right? So in this case, your loan would be $1,000 a month. And then when you go to settlement, the origination points are paid one time. They're paid when you close normally, right? At settlement. So you pay that lender an additional $3,000 for points, right? So you want to know the interest rate and the points. And like I said, it's normally expressed like 12 and 2 or 12 and 3 or whatever. That just means the rate and then the points, right? So be aware of that. The second thing are the terms. Number 1, you want to know, how is the lender being repaid, right? Do they want their money every month? Normally it's interest only, meaning that the payments that you make every month, those $1,000 payments, they don't take away from the $100,000 loan at all. It's just interest, right? So let's just say if you paid him 6 times, you paid him $6,000 because you had the property for 6 months. When you go to sell the property, you still owe him $100,000 on his original loan, right? You only paid off the interest each month for having the money out, right? So interest only. But you want to ask them, do you pay that every month? Are you going to pay that at the end when you settle on a property? That's ideal, but most lenders don't do that. Most do monthly interest payments, but it's worth asking. You never know. Sometimes it goes that way. You also want to know if you are paying interest on the total loan or the amount borrowed or the amount dispersed, sometimes they'll call it. So let me break down the difference, right? You have a $100,000 loan. Day 1, you're responsible for the total loan, which means that the first month, no matter what you borrow from the renovation part of it, you have to pay on the whole entire loan. So you have a $100,000 loan, you're paying 12%, you pay $1,000 at the end of that month for that loan, right? Then you have what's called loans where you pay on the money that has been dispersed or money that has been paid out of or that you borrowed. So let's just say our $100,000 loan that we have is broken down into 60% of it is for the purchase of the property and 40% of it is for the renovation of the property, right? So on those loans, you obviously are paying a 60 going into it because you're borrowing money to buy the property, right? Now, after settlement, you're already 60 in. Let's just say in that first month, you only do $10,000 worth of work, right? So at the end of the first month, you're only in that property for $70,000. Now, instead of you paying $1,000 like you would if you borrowed all the money, you'd only pay on the 70 that you borrowed. So you'd only be paying $700 that month. And then as you borrow more and more against the renovation and less of the money from the loan is like being reserved. So like, as you pay let's say you borrow another 10 the next month, you at 80. So then you pay $800. So every month you're paying a little less than you would if you had been charged the full amount up front. Now, some lenders do this. I have one lender that do this, and I've dealt with several that don't do it. So it's worth asking, like, hey, do I pay money? Do I repay on the total loan or the money that's been dispersed, right? That's how you would ask that. Next thing you want to know is what percentage of the ARV or after repair value is what it's called, do they lend on, right? So for most lenders, it's somewhere between 65 and 70%. And the more conservative a lender is, the lower that number will become. So what that pretty much means is that if you have a $100,000 house, right, and a lender is willing to lend 70% of the ARV, that means they'll lend you up to $70,000 between your purchase and your renovation to do the property, right? If they lend 65% of the ARV, that means they will lend you up to $65,000 of 100 to do the purchase and the renovation, right? So you want to ask the lender, what percent of ARV do you lend, right? And then sometimes lenders will also have terms that go a bit beyond that, and they call this skin in the game. Skin in the game pretty much means that I want to make sure, or I want to, from a lender's perspective, I want to increase the chances that you don't just take my money and quit this project because you don't have much to lose, right? So what they'll do is what they call skin in the game, which means that you have to put your own money into the deal regardless of what percentage of ARV you're at, right? And so let's just say you get a real good deal on a property, right? And you only need to be in that property 50% ARV. Let's say you're getting it for 30 and you're putting 20 into it. So by all right, you figure, okay, if he's lending 65% or 70% of ARV, then I shouldn't have to pay anything. I should just show up to settlement. And because I'm under what he's willing to lend, he'll take care of the rest. And some will. But some still say, no, I want you to have skin in the game. And skin in the game varies from lender to lender. It could be like 10% of the purchase price. It could be, 20% of purchase price. It just varies from lender. It's like case by case. The more comfortable a lender feels with you, typically, the less skin in the game they want you to have. But initially starting out, sometimes they may ask you for skin in the game. So just be aware of that even if your deal is really good and it meets the parameters and, it falls under the ARV that you would need in order for him to include the whole deal, they may still want you to put up money so that you have skin in the game, right? So that's that. The third thing is just be aware of the time of the loan. Time is crucial in these loans. I had a house that was a good deal. I had it for a long time and it cost me, sometimes you'll show up and you're looking at your settlement statement and you're just like, damn, like, where's the money? And you're looking for it and you're looking, something's gotta be wrong. And then you get to the lender line and you look and you're like, it just hurts, and it's time. Time is what does that, right? So you want to know, how long is the loan, number one? Like, how long are they allowing you to borrow the money before they normally not take the property, but normally it's some kind of penalty or, fee that you have to pay in addition to the original agreement for having the money longer.